Hi everyone, welcome to Call of the Week, my weekly YouTube video on the developments in the stock markets, what happened in the previous week, and the outlook for the coming weeks. So, last week was a somewhat disappointing one for the Indian stock markets, mainly due to the retrograde tax policies announced in the budget. So, initially, when the budget announcements came, most of the things were supportive of economic growth, but then the last part where the surcharges were increased so much have not gone down well with the markets because of one, uh, the the fact that the tax rates because of these increases go up much more than what is the ideal rate, and secondly, the potential applicability of the same on foreign portfolio investors, and the way the short term and long term taxes actually get increased because of these surcharges. For example, for apparently the long term capital gain tax is just 10%, but for someone who is in the highest tax bracket above 5 crores, because of the surcharge, the tax rate goes up by another. So on 10% you have to pay the entire surcharge. So effectively the short term capital gains tax, the long term capital gain tax actually becomes more near 14% rather than 10%, and the short term capital gain tax becomes more near upwards of 20% rather than the 15%, which is apparently the tax. So I think these are not very good moves, because you remember that till last year the long term capital gain tax was zero. From zero, we in just 1.5 years we have moved to 15%. So that reduces the post tax rate of equity investment and makes India relatively less attractive in the global context. So the government can keep on harping that we are the fastest growing economy in the world, but then if the tax rules keep on changing every year, then there is no tax consistency, and that will impact flows. However, that said, I believe that what's happening now on the monetary policy front, the way the bonds are rallying, and the fact that we are going to see significant monetary easing, which is already on the way, because some of the companies are indicating that from mid-June there's been a substantial easing of financial conditions. So that easing, combined with a potential rate cut by the RBI in the next policy and going forward also, will reduce market rates by at least 1 to 1.5%. And this reduction in market rates will lead to an economic revival. So despite the policies of the government on the tax front, I believe that because of the significant monetary stimulus, we will still see a very good economic revival, and which will eventually get reflected in the way the stock markets behave. A few companies reported results last week, and the results were pretty decent. IndusInd Bank reported a good set of numbers, and most of the concerns that were there in the stock and the company seem to be going away. Infosys results were very well accepted, and although they came after market hours on Friday, the ADR in the US markets went up by 5 to 6%, and that will reflect in the way the stock behaves in the Indian market trading also. So these are positive things among the mid caps. The big mid cap side, DMart reported results, and after a long time, growth and margins have seen an uptake. So which is also a positive, because it's a decently owned stock and followed stock. So I think there is excessive pessimism about the way the economy is going to behave and the way the company results will be. Expectations this time are very low, and as the results come out, my guess is that we'll see an uptick coming through in the way the markets behave. The second part was the way we've seen the global markets behave this week. So the US markets actually melted up, and we saw that US markets have done very well this week. US markets went to a new all-time high, supported by the comments of the US Fed chairman Powell, and the way the monetary policy could be going forward. So we are in a scenario today where global markets have done decently well. The US dollar index weakened this week because of the potential easing of the US Fed going forward, which will reduce the interest rate differential between the US and many of its trading partners. And in the Indian markets also, bonds rallied and the 10-year bond has gone to 6.49% end of the week. So from 8.2% in October 2018, it's at 6.5%. And as the spreads in the markets reduce, when as the liquidities improve, we'll see overall market rates also coming down. So we are well placed as far as the economy goes. There's going to be an economic revival, and that will reflect in the way stock markets behave. I still I'm of the view that in the second half of this year, we will see a 8 to 10% market uptick on the index and an outperformance of the mid caps. On the interest rate sensitive side, we have already seen that this week, although the markets sold off quite a bit, many of the interest rate sensitive stocks held on and actually went up during the week instead of falling. And that's one clear reflection of the way outperformance will lie going forward. So in a nutshell, my view is that the global context is still positive for equities. There is a significant negativity which is playing around in the minds of investors, and typically as it's a contrarian indicator that risk assets will do well. Inflation overall in the global context is well under control, because except for crude oil, which has gone up because of Iran, US, etc. conflicts, and still it's just at around $65-66, most other commodities are down. So we've seen a crash in global cotton prices also over the last few weeks, which will be supportive for the textile industry. Similarly, many of the companies which consume metals, they will also see an uptick in margin. So in a nutshell, I think we are pretty well placed going forward, despite what the government has done on the taxation front. So that's where I'll leave my comments right now. Next week is pretty heavy for results, so we'll see a lot of company results come out, and that will give us a better perspective of the coming few weeks. So bye for now, and I'll come back next week.